All right, everyone. I think we can go ahead and get started. We have a lot of material to cover today, so I don't want to keep you all waiting. Good afternoon, and welcome to the final historic tax credit webinar, where we will be covering the topic of Part 3 applications. We're very excited that you guys are joining us today, and especially all of you who have joined us for all of these webinars. It's been a really great experience, and all of them are posted on our website. As this one will be when we're done today. Today, we are joined by the entire tax credit team here at the Division of Historic Preservation, as well as our colleagues at the Louisiana Department of Revenue, who will be presenting on the tax credit certification process. So my name is Andrea McCarthy. I am the director of our Historic Tax Credit Program here at the Division of Historic Preservation. We are part of the Office of Cultural Development, which is under the Department of Culture, Recreation, and Tourism, and that is headed by the Lieutenant Governor. And I will let our tax credit reviewers introduce themselves.
Hi, everyone. I'm Emily Van Dorn. I'm still a tax credit reviewer here in our office. Great to see everyone on the call today.
Hi, everyone. I'm Theron Jones.
And then we have our admin coordinator.
Hi, my name is Tristan. I'm the admin coordinator.
Thank you. And then our colleagues at Louisiana Department of Revenue.
Hello, Kent Laplace, Louisiana Department of Revenue.
Hi, I'm Haley Gavi. I'm with Louisiana Department of Revenue.
Thank you. All right, so let's get started today. We're going to go ahead and turn our cameras off so we can focus on the contents of the presentation. Like I said, we have a lot to cover. So today, we're going to go over the program that we administer here at the Division of Historic Preservation. But first, we're going to introduce some of the recent program changes that passed during the recent special session of the legislature, and what that means for our projects as we begin the next year. We know we'll have a lot of questions, so we do want to encourage you to put those questions in the chat if you can, and we will answer them. If you need something immediately, you can, of course, raise your hand and we will call on you. But let's keep some of those longer conversations for the end of the webinar, if at all possible. So once we go over the legislative changes, reviewing the new statute language, the new cap, and the process for updating the program rules, we will move on to the regular programming, which includes the Part 3 applications. We'll go over how to fill out the application form, how to pay Part 3 fees, how to submit photographs, and then we'll hand it over to the Louisiana Department of Revenue, who will review the credit certification process. They'll go over credit earning rates, the appeals process, and finally, they will discuss what happens after credit certification, how your credits can be used, sold, or transferred. So once again, we'll introduce our two tax credit programs that we administer. We administer the Federal Historic Rehabilitation Commercial Tax Credit, which was established in 1976 as part of the National Historic Preservation Act. This is a 20% credit on the money spent rehabilitating the commercial historic building. It is for income producing properties, and there is a 5-year recapture period. We also administer the State Historic Rehabilitation Commercial Tax Credit. This was established in 2002 by the Louisiana Legislature. It was most recently updated in 2024, this year, in a special session. It's a 25% credit, and that is 35% for rural areas. This is for income producing properties, but there is no recapture period on this credit. As we will hear about today, they can be sold or transferred. And of course, most people know that you can stack these credits and use them both simultaneously to obtain 45% or 55% in rural areas. So I do want to touch base on our partnerships. We do work closely with the National Park Service and the IRS to administer the federal credit. And then for our state historic credit, we work very closely, as you'll hear today, with the Louisiana Department of Revenue. And then briefly, we'll touch on our minimum expenditure requirements. Once again, these expenditure requirements are in QREs, which are qualified rehabilitation expenditures. This is the money that you spend on the actual renovation of the building, and we'll hear more about that today. For our state program, the minimum expenditure is $10,000. And for our federal program, you do have to meet that substantial rehabilitation test, which essentially is the adjusted basis value of the building, the cost of the property minus the land. All right, so let's begin today's discussion by reviewing some of the changes that occurred during the 2024 third extraordinary session of the Louisiana Legislature, which took place November 6th through the 22nd of this year. So originally drafted as HB2, the original version of the bill proposed sunsetting the state historic commercial tax credit on June 30th of 2025. Throughout the session, the bill had a number of amendments in the House and the Senate. And in the end, we were able to retain the sunset date of December 31st, 2028, which was the existing sunset date. But they did lower the overall cap of the program, and they removed our rollover, which is what allowed the unused cap to move forward to the next year. So this bill was signed by the governor just last week on December 5th. It is now referred to as Action Number 5. So here you see the language of the updated statute. At the top, this is referring to projects that were received on or after January 1st, 2021, but prior to January 1st, 2025. So that's at the beginning of the next month. The maximum aggregate total of tax credits that may be reserved by all taxpayers shall not exceed $125 million annually, and the credit reservations issued can be rolled over to the next year. So that is essentially keeping in place the cap and the rollover for projects where the Part 2 is received between January 1st, 2021 and January 1st, 2025. The next section of the bill proposes the new cap for Part 2 applications received on or after January 1st, 2025. The maximum aggregate total of tax credits that may be reserved by all taxpayers shall not exceed $85 million annually. And there is no more clause for a rollover. So that $85 million annually is all that can be reserved. And then, of course, the statute gives the Department of Culture, Recreation, and Tourism, which is our department, the ability to establish rules for how tax credits are reserved, which can be a first come, first served basis or any other method that we determine to be beneficial to the program. We will go over that in a little bit. So that's the language. Just to summarize that, before January 1st, 2025, the cap was $125 million a year. With the large cap and the ability to roll over unused reservations, there was a large cushion, and so there was never really the risk of running out of credits. For this reason, we were never aggressive about getting reservation forms until the Part 3 was approved, because of course that is a requirement. But this is something that will change moving forward, as you'll hear about today. Before we show you the changes, I did want to pull up some data for the past few years. This shows how many credits were actually reserved starting in 2021 through this year, 2024. And as you can see, only a small amount of credits were reserved for those early years. This is generally because credit reservations were not required for Part 2s received before 2021. So essentially, this provided us with a large rollover amount. And while in the subsequent years we did have more reservations, they were still only a small percentage of the overall reservation funds. However, you will notice that this year we have already issued 143 million in reservations, which is well above the new cap that will begin January 1st. So it's difficult to predict how this new cap will impact our projects. We wanted to look at some of the different numbers. We looked at the actual QREs that we've approved each year. And here you can see that we've surpassed 85 million in anticipated credits for 2022 and 2023. Likely we will surpass that again this year once we finally cap up the December 31st date. However, because reservations are more closely tied to Part 2 approvals, we also wanted to look at the Part 2 data. And based on Part 2s approved over the past 2 years, we would anticipate those reservation amounts being just below that $85 million threshold. And so the intention of sharing these numbers is to show that while we don't anticipate the lower cap to be a huge blow to the availability of the historic tax credits, we could easily hit the cap towards the end of each year, and we do want to be prepared. And we want to be particularly cognizant of large projects, which in the past have reserved upwards of 40 million in credits for a single project. So here's the summary of the new legislation. The credits are capped at 85 million. Unused credits are not going to be rolled over. All of the previously rolled over funds, which is over 200 million, those will no longer be available for projects where Part 2s were received after December 31st of this year. And so we will be proposing some changes, such as phasing out the actual reservation form in lieu of a Part 2 application that includes the reservation request within it. And so part of our responsibility is to update our rules. Here are the existing rules, and I've highlighted the areas that will need to be updated. We've been given discretion on how to approach the rules. For instance, we do not have to use a first come, first served basis. We could consider weighing smaller projects or rural projects differently. We could even consider capping projects. However, we do not at this time want to make such substantive changes to the program without working within the new cap for a year or two, and also seeing what additional changes might come in the next legislative session. So therefore, we're taking a very targeted approach of proposing minimal updates to the rules, only to keep them consistent with the new legislation. So this includes updating the reservation amount, which is written into the rules, $125 million, which we will likely change to just refer to the program legislation cap. And then also we will have to remove the clause about the rollovers. Here you see an area where we are looking at making a little bit of a change. Right now, the rules give phased projects the option of submitting a single or multiple reservation requests, and we are going to propose requiring separate requests for phased projects with the option to apply future phases to future years that fall within the existing program sunset dates. We believe this will reduce the impact that these very large projects will have on the overall availability of reservations each year. Additionally, the rules detail the timing of reservation approvals, and this will change because we are proposing to have the reservation be a part of the Part 2 application. So when your Part 2 is approved, your reservation will also be approved. We won't be proposing any changes to how credits are forfeited or rescinded. And also you will be able to request additional reservations through an amendment form, which we are proposing that we will use the traditional amendment form, project amendment form, and include a section in there that specifically references the reservations. So that is that language that would be slightly modified. So this is just a summary of the rule changes. Now, this rule change process is a 6-month legislative process, so it doesn't happen quickly. And we do want to get started on these rule changes, hopefully in January. So starting January 2025, these are the programmatic changes that we're looking at. We will be eliminating the tax credit reservation form. We'll be updating the application forms, and we'll be requiring phased projects to submit separate Part 2 applications. Here you see a draft version of the new proposed Part 2 application, which will include the reservation request. The request will be on the second page along with your project information, and the approval will be just above the signature line. When a Part 2 is approved, the reservation is also approved. And we will still have an option of a partial reservation or moving a reservation to a following year if that cap has already been met, as the existing rules do allow for this. And we believe this will streamline the process of reserving tax credits. In the meantime, if you have an approved Part 2, we encourage you to get your reservation request in as soon as possible, because we do want to make sure that you're taking advantage of that previous rollover money that will be disappearing for Part 2s that aren't submitted before the end of the year. We definitely encourage you to contact us if you have a large project, if you're holding a Part 2. We think you should just get it in as soon as possible, because the legislation only requires that the Part 2 be submitted. It does not require that it be approved. So we may be able to waive some of the requirements, such as architectural drawings, and have you submit those at a later date when they are ready. But we do want to be able to take advantage of as much of that reservation cushion that is going to be going away at the end of the year as possible. So this concludes our discussion on the legislative updates. We can hopefully have conversation at the end of the webinar. If anyone has any immediate questions, they're more than welcome to raise their hand. Otherwise, we'll move on to the regular programming of Part 3 applications.
Okay. The Part 3 application is submitted once the project has been completed and has 2 main requirements: photographs and expenses. We will discuss the photographic requirement shortly. For the Part 3 application, we just need the total amount of qualified rehabilitation expenditures that were spent on the building. After you receive your Part 3 approval, you will need an itemized list to send to the Department of Revenue. Kent will go into more detail on what you need to submit to LDR a little bit later. The Part 3 application includes the project's placed in service date. This date is generally when the work has been completed to a point which would allow for occupancy of the building. The Part 3 application should be submitted only once the building has reached this level of completion. There's no requirement that a Part 3 be submitted within a certain time frame, such as by the end of a calendar year or within exactly 2 years of the project start date. Please keep in mind, however, that the credit can only be claimed beginning with the year when the building was placed in service. Pictured is the federal Part 3 application form. This form is fairly straightforward and will include a lot of the same information you have already seen on previous applications. Make sure to fill in all project data on the form. This includes project start and end date, total QREs, as well as total project costs, which includes QREs and non-QREs, number of housing units, and number of low-income housing units. All of these fields must be filled out. They cannot be left blank. For example, if you have no housing units, you will need to enter 0 for those fields. When signing, be sure to check the appropriate ownership box. These options are a little different than they appear on the Part 1 and Part 2 application forms, so make sure to read each item carefully and only select those that apply. There's a second optional page to list additional owners, if any. As always with digital applications, the signature can be a digital signature or a scan of a physical signature, but may not be typed in a handwriting style font. The state Part 3 application is very similar to the federal Part 3 application. However, due to differences in the state program, the form is a little longer, 2 pages instead of 1. The main difference can be found in the QRE section on the second page. The state credit rate was increased beginning January 1st, 2023, from 20% to 25%, or 35% for rural areas. All expenses incurred prior to that date are eligible for the 20% credit, and all expenses incurred from 2023 onward are eligible for the higher credit rate. This means that if your project began before January 1st, 2023, you will need to calculate your qualified rehabilitation expenditures separately for each period. Both the federal and state applications are available on our website, which can be accessed through louisianahp.gov. As discussed earlier, the application forms are updated periodically, so it's always best to make sure you have the correct current form before beginning your application. Outdated forms will be returned. There are a few instances where the Part 3 submittal process is different between the federal and state programs. One of these is phase projects. For federal projects, a phase advisory determination can be requested at the end of each phase. A phase advisory determination allows NPS to review the completed phase and determine whether the work meets the SOI standards. This can only be completed for phases of a project that have already been defined in the Part 2 approval and meet the NPS requirements for what constitutes a phase. Phase advisory determinations are submitted through the federal amendment form. The Part 3 application is only submitted at the completion of the final phase, once the entire project has been completed. The filing process for phase state projects is a little different. Each phase of the project will have its own state Part 3 application for that specific phase. This means that for all phases prior to the final phase, you'll be submitting a federal amendment form and a state Part 3 form. Another example of where the process varies is with revised Part 3 applications. In many cases, the final QRE amount may not be fully calculated at the time the Part 3 is submitted, and the number provided is an estimate. If the final QRE total is different from the number provided on the Part 3 application, paperwork must be filed to record the change with each agency. For federal applications, this will be a Part 3 amendment, which is completed on the standard amendment form. For basic changes to the project information, not changes to scope of work, these can be emailed directly to NPS at nps_TPS@nps.gov. For state applications, to update Part 3 information, you will need to submit a new Part 3 form with the correct information. There is a box at the top of the state Part 3 form to indicate whether it is a revised Part 3. The same procedure is followed for other changes to Part 3 project data, such as updating ownership information.
Okay, so now I'm going to talk about fees really quickly. As for the fees for the federal Part 3 applications, NPS has a completely different process from us. NPS should send you an invoice, and they do accept online payments at this time. As of right now, we do not have a way to accept fee payments online. We are trying to get that all sorted out, but in the meantime, we will still only be accepting checks. We strongly encourage waiting for the invoice before sending in the fee to help us avoid returning or shredding checks. Having to request a new fee and waiting for it to arrive can also delay the completion of the review for your project. You will receive the fee invoice via email from me, Tristan, and the email will have the invoice as well as a spreadsheet copy of the free worksheet that we use to calculate the fees. When sending in the fee, we ask that you send a copy of the invoice with the check or a note or put the state project number on the memo line of the check, so that way we can know what project the fee is for. If you submit a revised Part 3 and there's a significant increase in the QREs, we will ask for an additional processing fee. The request email will look a lot like the first request. So it'll have that attached invoice and a revised fee worksheet that explains the new total that we're looking for versus what you had already paid in the past. If when you receive that fee invoice, you see any typos on the invoice or on the fee worksheet, please reach out to me and let me know so that way we can make sure that the fee comes back at the correct amount.
Okay, we're going to talk a little bit about the Part 3 photo requirements. The Part 3 photos are just as important as the Part 1 photos. It is important to clearly document the work after it is completed. If the photos are not sufficient, we may request more documentation of the completed project. Photos must be in color and high resolution. And remember that large or complex projects will probably require more photographs because you must tell the full story of the project. This goes for Part 1 and Part 3 photos. And you can refer back to the photo documentation webinar for more details on how many photos for a particular project. So just like with the Part 1 photos, you want to make sure your photos are key to a plan. Sometimes the floor plan changes after the rehabilitation project is complete. So you really want to make sure the Part 3 photo plan and the photo key are as accurate as possible. If your rehabilitation project included features such as landscaping, signage, additional buildings, these are required for the Part 3 photos as well. Please keep in mind that all changes to the property and the building are important. So you might not have had photos of the lawn for your Part 1, but we don't want things such as landscaping or signage to completely block or overwhelm the character defining features of a building. So although numbering the photos is exactly the same as Part 1 photos is not required, it is helpful to help us with the before and afters, but it is not required. Be sure to document any historical features that were. So you can see here on the left that the screen door was removed, the facade was painted, and the door was painted. On the right, the kitchen's historical features were retained and painted, and the floor was replaced, and countertops were added as well. Yeah. This image on the left exhibits shutters that were painted, and the image on the right has a fireplace that was retained, and the historic one is also retained. Just giving you all some before and afters. Next.
All right, so once we receive all the required documentation, DHP will have 30 days to complete the review. If you're also applying for federal, this will be 60 days as we have to send the application to the National Park Service. We do require National Park Service approval before we will process the state Part 3 application for those projects. Also, we will not issue the final approval documents until the fee is paid. Once that happens, the documents are all received, the work is approved by the state and federal agencies, and the fee is paid. We will issue a signed Part 3 approval and a 6121B form that will certify your project. These documents will be submitted by us to the Louisiana Department of Revenue on your behalf. Please note that the documentation of expenses should not be submitted to the Division of Historic Preservation. These will go directly to Department of Revenue in a manner that they will go over in the next section.
Good afternoon. This is Kent LaPlace again. I'm with the Department of Revenue. And we're going to cover several items as far as the processing and certification of the tax credits. First of all, we talk about the Part 3 certification. We'll talk about our review process. This is an outline of what we'll discuss. Required documentation, the audit report, related party and large payments, small project exceptions, additional information, common mistakes, expenditure samples, LDR revenue timeline, We'll mention the rural areas, some frequently asked questions, and we'll go over our appeal process. Then we'll discuss the after credit certifications, the credit registration, the transferring of the credits, claiming the credits on the tax return, and claiming the credits as a payment. And then we'll wrap up with questions, reference information, and contact information. Part 3 certification. Early in 2014, representatives of the Department of Revenue and Division of Historic Preservation met to decide how the certification of the credits would be conducted. We also needed to know who would actually do the audits. Being that Department of Revenue has more experience auditing records of taxpayers, and that we could cross-verify other tax filings, it was decided Department of Revenue would handle this portion of the certification. In addition to the Part 3 that was already issued by Division of Historic Preservation, a new form, R6121B, was developed. While the entity requesting the credit prepares the Part 3, Division of Historic Preservation prepares the 6121B. The bottom portion of the form is used to calculate the tax credit. So again, after the Division of Historic Preservation finalizes the project approval, they send the approved Part 3 certification of completed work to the Department of Revenue. The partially completed Form R6121B, which is the agency certification of credit to the Department of Revenue. We are responsible for verifying the qualified rehabilitation expenses and certifying the tax credit amount before the credits can be transferred or claimed on the tax return. Since the Department of Revenue has been certifying these credits in 2014, we have certified 1,608 projects. Of these projects, 835 had have some sort of adjustments. So 52% approximately of every file project that we've looked at has been adjusted. In excess of $4 billion worth of qualified expenditures have been approved, and we have certified over $935 million in credits. And due to our review process, we have reduced disallowed credits of over $28 million. When the department receives a Part 3 from the Division of Historic Preservation, we send a letter and an email to the applicant listed on the Part 3, along with a copy of the department's rule, which outlines what documentation must be submitted for approval. The letter will provide the applicant options on where to submit the documentation. The email box of taxcredit.registry@la.gov is the preferred place to email the documentation. Also, for projects that submitted a Part 2, the Division of Historic Preservation that was received by them after December 31st of 2020, we will also ask that they provide a copy of the tax credit registration form. We cannot approve the certification without this form. Required documentation first is an auditor's report. So should be prepared by a certified audit report prepared by an independent auditor with the following requirements. The CPA must be independent third party, licensed in Louisiana, and included in the Louisiana Legislative Auditors listing of approved CPAs. The audit opinion must be addressed to the party who engaged the auditor, but may expressly permit others to rely on the same. We'd also ask that the Department of Revenue is added as one of the parties that may use this information. Include the name of the CPA firm, the address, and the telephone number. The opinion must be dated no earlier than the completion of the field work. Must be performed in accordance with auditing standards as set forth by the American Institute of Certified Public Accountants and have sufficient knowledge of accounting principles and the Secretary's Interior standards for rehabilitation. Periods during which qualified rehabilitation costs were incurred must be noted. Kindly review the beginning start dates in the audit report and a completed placed in service date so they agree with what's on the Part 3. If they do not agree, we will ask for an explanation. We also require a breakdown of related party transactions. We need the name of the related party, the nature of the relationship, the nature of the transaction, the amount of the transaction, and we also will ask how the cost compared to what an independent party would have charged. Report should be accompanied by cost report of the QREs, notes to the cost report, and a completed CPA certification form. The federal and state identification numbers and address must be provided for related parties that receive payments greater than $10,000. For payments to any vendor of $100,000 or more, the Department of Revenue will require the name, address, federal and state ID numbers, any state or local license number, such as a contractor's license, and the total amount paid. This form is R-6122, Rehabilitation of Historic Structures Tax Credit, scheduled for payments of $100,000 or greater. The reason we ask for this is that we use this as audit leads because we have found over the years a number of vendors who are not registered in Louisiana but are receiving payments from Louisiana and earning income. Also, too, if a project is in phases and the total of all phases is greater than $500,000, they may be required to use an audit report. Now, this is a sample copy of our related party schedule, and it puts out the name, the nature of the relationship, the nature of the transaction, and the amount. The next slide shows a copy of the R-6122. And this form can be obtained on our website. Now, once the department began requiring an audit report, many entities or individuals who had smaller projects expressed some concerns that they now had a new cost that they had not anticipated. In order to offer some consideration, the department amended their requirements for projects with total cost of $500,000. They can still obtain an audit report if desired, but there are some alternatives they can use. Also, please remember it's total cost of $500,000, not total QRAs. So the applicants with total project costs of less than $500,000 may submit the following in lieu of an audit report: an itemized listing of all QRAs and non-QRAs expenses, detailing their eligibility, and the schedule must include the category of work, method of payment, date paid, designated if related party, description of the work, and whether there's a QRE and non-QRE. We need both QREs and non-QREs. The next slide shows an example of report spreadsheet that can be used to accomplish this. Also, in lieu of the audit report, we would need a copy of each invoice for any expense that was $2,500 or more. Now, this is an individual purchase of $2,500 or more, not a total of multiple expenses that equal $2,500 or more. And if on your spreadsheet you put an amount that's $2,500 or more, it must have an accompanying invoice. If that is a total, then you will need to identify the individual expenses. We require a notarized statement attesting that the expenditures were incurred in connection with the rehabilitation of a certified historic structure that is properly charged to a capital account. You will also have to identify related party transactions that are outlined under Financial Accounting Standards number 57. One thing to remember, if you pay yourself a fee, that is a related party. And again, as I said, if you phase a project and the total cost of all phases is greater than $500,000, you will need audit reports for each phase. Some additional information. We review the tax filing history of entities and individuals who are requesting the tax credit. For flow-through entities, we request the names and tax numbers of the entity and our individuals who report the income. Missing tax returns or outstanding liabilities may result in a delay of the issuance of the tax credit. Purchases of tangible personal property utilized in these projects are subject to Louisiana and local sales taxes unless specifically exempted by law. The credit cannot be given for expenditures paid by state or federal funds, and expenses for moving a structure do not normally qualify for the tax credit. Over the years, we have had many businesses who have owed sales taxes that had to become compliant, or individuals who have not filed tax returns where the credit couldn't be used to offset the tax liabilities. In fact, one firm, CPA firm, reported that one of their clients who filed for a project had to pay over $200,000 in use tax on items purchased directly for use in the project. Some common mistakes that we see is the start, begin dates, and the end and place in service dates on the Part 3 audit report and expenditure schedules are not consistent. As stated earlier, reviews these dates and we'll ask for an explanation if different. If QREs on the Part 3 and the 6121B do not agree with the QRE in the audit report or the schedule of expenditures. If the QRE amounts on the Part 3 and 6121B are greater than the amounts on the schedule, then that is fine. You do not have to get a revised report. However, if the Part 3 QRE total is less than the auditor's report or the schedule of expenditures submitted for review, a revised Part 3 will have to be obtained, which has the higher QRE total. Please identify related party transactions are not identified and copies of the agreements are not provided. And again, projects less than $5,000 do not include a notarized statement attesting expenditures were incurred in conjunction with a certified historic structure and properly charged to a capital. The next slide shows a copy of a schedule that is not acceptable. As you can see, all the construction costs are put in one line. All the architecture, all the soft costs are put in one line, and fees are put in one total. Now, the next slide will show a better division of expenditures and what we would like to see. This gives us a better picture as to what will actually occur on the project. As far as our review timeline, reviews typically take 30 to 60 days from the time the audit report and/or required documentation is received by the Department of Revenue. If the documentation is incomplete, the review time will take longer. Credit earning rate prior to 1/1/28, the credit was 25%. From 1/1/18, excuse me, I said 28, I'm sorry, 1/1/18 to 12/31/22 is 20%. And from 1/1/23 forward is 25% and 35% for projects that meet the definition of rural. An example, if an expenditure was incurred prior to 1/1/18 but paid after 12/31/17, the credit is allowed on the 25% rate. However, documentation must be provided to verify that expenditure was incurred prior to 1/1/18. The same goes for the change in the credit rate from 22 to 23. And again, it is when the expenses are incurred. If there is no division of expenses, we will process the credit at the lower rate. Also, please review soft costs, as we have seen some cases where all soft costs were allocated to the higher tax rate period and not spread over the life of the project. A couple of FAQs we have. Are expenditures outside the beginning start date and the ending place and service date allowable? Well, they may be. Some soft costs prior to the beginning and start dates will qualify. And some costs after the completion, place, and service date may qualify if in the same calendar year. If expenditures are incurred after 12/31 of the year that the Part 3 shows the structure was completed or placed in service, you may need to secure a revised Part 3 with a new completion date. The Department of Historic Preservation approved my enlargement, so the expenditure should qualify. No. Any enlargement expenditures do not qualify. The Division of Historic Preservation approves the project, but they have to approve the project so you can get expenditures on the part that does qualify. If they did not approve the project, you would get no tax credit. Okay, we can now come to our appeal process. Oops, rural area, I'm sorry. Appeal process. A denial letter is sent to an applicant outlining the adjustments to the submitted credit, detailing the appeal process. This letter is sent both certified and proof of mailing. Appeals are sent to the Assistant Secretary for the Office of Legal Affairs. Written notice of the intent to appeal must be received by the Department of Revenue within 10 business days from the date of the denial letter. The full appeal must be received by the department no later than 30 calendar days from the date of the denial letter. Appeals must be in writing and must detail specific reasons the denial should be partially or completely considered or overturned. Upon showing reasonable cause, the Assistant Secretary may extend the deadline for submission of the full appeal. The Assistant Secretary, at his discretion, may hold a hearing in connection with the appeal. Upon review of the appeal and consideration of the hearing, if applicable, the Assistant Secretary shall take one of the following actions: sustain in full or in part the denial, overturn in full or in part the denial. The Assistant Secretary's final written decision to any appeal must be issued no later than 90 days after receiving the full appeal. Now, Ms. David will discuss the after credit certification of the tax credits.
Hi, my name is Haley David with the Department of Revenue. And I'm going to discuss with you what happens once Kent's through with his process. The first thing he does, he's finished with his and everything is signed off. I will receive the 6121B that has been completed and signed. And it'll have the amount of credits that are going to be certified. Once I get this, these are registered in our tax credit registry. And I issue the form R6135, which is the credit registration form. I'll send that form, the R6135, and the completed R6121B in an email to the email address that's on the Part 3 certification. These are normally sent in email. They're in an encrypted zip file, and you'll receive 2 emails from me, one with the zip file and one with the password. Once you receive those are for your records. I don't need those back. From that point, on the next slide is a copy of the R6135. So I'll go over the credit owner. This is the only person or entity that can claim this credit, is who's on this 6135. The date credit earned is the tax period that the credit can be used on. So on this sample, 11/1/22 is the placed in service date. So these credits are valid from tax period 2022 through the expiration date, which will be 2027. The credit expires with taxable periods 12/31/27. Also on here, you'll see the credits can be used to pay an outstanding liability is no. Anyone who earns transferable credits, they don't have the option to use these as a payment. These are only allowed on the income tax returns. And the amount of your credit will be on the bottom of this form. That'll show your total amount of credits that are registered to you. On the next slide, we're going to talk about how you can transfer your credits either to a member of that LLC that they were registered to or to a third party. When you're transferring credits to a partner or member, you will need to submit the Form R6140 Credit Utilization Form. On this form, you will fill out Section 2 of that form, and you would submit a copy of the R6135 along with a check for $200 for a transfer fee. This would need to be done for each member or partner. If the credits are being sold to a third party, you will still need those same documents, the R6140, the R6135, the transfer fee, but you'll also need to provide a copy of the contract of sale. All of those documents have to be received within 10 days of the date of transfer. If these are received after the 10 days, the transfer date will be the date that we receive these credits. And the transfers are not effective until these are recorded in the tax credit registry. And to claim the credits on a return, you would just put these credits on your return using code 253, and you would attach a copy of your R6135, your credit registration form. If the credits are transferred after the due date of the return without regard to extension, and normally this date would be May 15th, you would need to complete the Form R6111. An agreement to transfer tax credits would have to be completed on or before the due date of the return without regard to extension. So if your credits were transferred after May 15th and you claim these credits on your return, you would need to attach your 6135 along with your completed R6111 that was executed before that date. The buyers of the credits do have the option to use the credits as a payment. To use these as a payment, you would complete Form R6170, a transferable credit payment voucher, and a copy of your 6135. And these will be used as a payment against any outstanding tax liability. They can also be used to pay penalties and interest. The effective date of this request is the date that we receive it. And that's all for transferring credits or using them on the returns.
Okay. We're going to wrap up our presentation. I have skipped a question slide since and so I will go to reference information. We have RS 476019, which is a statute. Our rule is LAC 61:1.1917. Revenue Information Bulletin 14-005 deals with the tax credit registry. Revenue Information Bulletins 14007 and 14007A were written when we first began this program, and all the information in both of those revenue information bulletins is included in the rule, which was listed above. Revenue Information Bulletin 17008. It deals with the claiming of a transferable credit on a return. In all forms, revenue information bulletins and rules are available on the department's website at revenue.louisiana.gov. The next slide gives you some contact information for both Ms. David and myself. And they did have a question about what is a related party. I did mention earlier that a related party, if you paid yourself, it was a related party. But it's basically any business or individual that might be related to you, or any business that you own or have a part ownership in. That would be a related party. And that is the conclusion of our portion of the presentation.
All right, thank you, Kent. Thank you, Haley. We're gonna go through some of these questions. I'm gonna start with the one that just popped up on the bottom. Is it permissible for a property owned by an LLC to qualify for a tax credit if it's rented to the owners who occupy it as their primary residence? That's kind of seems like doesn't fall under a commercial use. Kent, you want to speak to that?
Well, an owner who lives in the property, that portion wouldn't qualify. Paying an LLC, that's something we would have to get a legal opinion on, but I would think that would be circumventing the rule on whether or not you can actually qualify for the credit.
All right. If the ownership changes during the course of the application, you can just either send an amendment form with the new ownership information, or just include that updated contact information on the next part of the application. That's not a problem. The most important thing is that when you are filing your Part 3, that you have the correct owner or LLC in that section, because that's who we're going to be putting on the 6121B form. So that is who LDR will be registering the credit with. And yeah, Kit, if you want to address the cabinet question.
Yeah, initially cabinets were not allowed, but over the years there's been some allowance of cabinets. If it's something that's built into the property, which would cause severe damage to remove the cabinets, that would be something that would probably qualify. If it's something you just buy from one of these big box stores or whatever that you just tack up on the wall and can be easily removed and does almost no damage to the property, then those would not qualify.
Thank you. And then, unless you mute yourself, Kent, before I.
Excuse me?
Okay, I had to mute Kent. All right, so if someone reserves a credit based on their Part 2 in an earlier year, that reservation is still valid, even if they have not completed their project for a few more years. So the reservation is not tied to the year that you finish your project. The reservation is more closely tied to your Part 2 or whenever you send in your reservation request. So if you have an approved reservation, that will still be valid as we move forward in these years with the lower cap. A lot of people are asking if we can get a copy of the slides. If you just send us an email, we can get you a PDF of the slides. And of course, this recording will be posted on our website. I think most of the other questions are answered in the chat, but I'm trying to read this last question. Yes, so if a portion of the property is a rental, then you can get the credit on that portion of the property. I think that's all the questions. Feel free to reach out to us if you have any more. And I think with that, this concludes our webinar series. Thank you all for joining us. Hope you guys have a happy holiday. And we will be expecting to get a lot of applications for the end of the year. So we'll be ready. And then expect to see updated Part 2 applications starting January 1st. Thank you all for joining us.